Hello investors! Today we are continuing the investment thought experiments. Last week we discussed how to buy a Rolex with your dividends. If you haven't seen it, please check it out after this video. For today, I wanted to do something a little more challenging. Not only more challenging, something I personally battle with year in and year out. Is it better to buy actual real estate or just buy into real estate investment trusts or REITs? In this video, we'll cover the difference between the two, some pros and cons, and at the end, I'll share a mock 10-year analysis of the two so that we can compare. If you like the concept of this video, please give us a like and subscribe so we know to make more content just like this. Also, leave a comment below on what you'd like to see us battle with in a future video. Let's start with some high-level differences between REITs and real estate. Real estate investment trusts are companies whose sole purpose is financing, buying, and/or managing properties and distributing those profits through a dividend to shareholders. REITs can be public or private. Public REITs are traded on exchanges just like a stock. Private REITs can be bought into by the appropriate broker of those REITs. REITs have some really nice benefits, such as ease of access. If you are new to investing and don't have a lot of money but want to try real estate, REITs are perfect for you. You can buy a single share of a REIT on any trading platform and start your journey in just a couple of minutes. REITs also offer instant diversity. If you want to mix your real estate holdings with some residential and commercial properties, you can do that instantly. If you want to just diversify your residential holdings into different geographies, you also get that instantly with a REIT. And finally, liquidity. In a crunch where you need cash quickly, you can sell your publicly traded REITs and cash out immediately. So that's REITs. Let's talk about real estate. Simply put, investing in real estate generally means buying a property and then leasing that property to a renter. This is a higher barrier to entry compared to REITs because you need to buy a property, and properties are expensive. The benefit here, you don't need to buy the property outright. You can take a loan on the property with only 20 to 25% down as an initial payment. Still, if you are buying a $100,000 property, then you'll need a down payment of at least $20,000 plus some fees on top of that for closing costs. Some benefits to real estate: leverage. And this is a massive benefit. You can leverage the OP 30-year mortgage for your very own portfolio. You've probably heard it from other investors or other videos before. Buy a rental property with a mortgage and your tenants are paying off that mortgage. It's dope. Taxes are another benefit. The US tax code is totally hacked to favor owners of real estate for business purposes. As a landlord, you can take advantage of depreciation benefits for writing off gains, and you can sell properties for massive gains, and as long as you reinvest those gains in another property within the same tax year, you won't pay any taxes on those gains. There are others, it gets really complicated. Also, I'm not a tax guy, don't take tax advice from me. The defense of, I heard it from a guy on the internet will not hold up during an IRS audit. Get yourself a professional tax person. There are some cons worth highlighting for real estate. They are fees. Closing costs can be expensive, lawyer fees, real estate agent fees, surveys, inspections, insurance. There are local laws and regulations you will need to follow. There are way more upfront costs for sure. You'll also want to incorporate, which are more fees. The best guidance for becoming a landlord is to form a limited liability corporation to obfuscate your personal finances from the liability of being a landlord. Same warning as the tax advice, go get a lawyer. Don't take legal advice from a faceless guy on the internet. And time. Buying, owning, and maintaining an investment property costs your time, which is your most valuable asset. You can outsource some of this work, but then it's starting to eat into your returns. At a high level, that is REITs versus real estate. So which is the right option for you? Let's imagine a scenario where you have $50,000 to invest. You could put that into a REIT or maybe a pool of REITs, or you could use that to buy your very first rental property. Which option is going to be more profitable? To try and answer this question, I created a calculator. I will share the calculator in the description below. Please take it, make a copy of it, and make it better. or just rip me to pieces in the comments. It's far from perfect. I might try to make it better, and we'll do a part 2 of this debate in the future. Here is version 1. We have one tab for the REIT scenario and another tab for the property scenario. We have a breakdown of revenue year over year and broken down by quarter to reflect the compounding effect of the REIT and reinvesting those dividends. Compound interest is the most powerful force in the universe after all. On the right-hand side, we have our variables. $50,000 as a starting balance with an average 5% yearly dividend rate and an average growth rate of 2% year over year. You can modify these values based on whatever REIT you choose and whatever you believe these values to be in the future for that REIT. In our example, I chose 5% because that seems pretty reasonable right now. With 2% growth, that's a conservative rate over the past 10 years. Who knows if it's reasonable for the next 10 years? After a period of 10 years with these variables, we turn our $50,000 into a little over $100,000. That's not bad. Let's take a look at the real estate side. We have a lot more variables, and this is a simplified version, keep in mind. We have our starting balance, $50,000. With that, we can safely buy a home for about $225,000. That would require roughly $45,000 down payment, and I'm assuming the other $5,000 goes to closing costs and fees. Our mortgage rate is 6.5%. Ouch. Property taxes are $5,000 per year. Insurance is $600 per year. Our monthly mortgage payment is $1,137, which includes principal and interest. I used the bank rate mortgage calculator for that one. Let's assume we can get $2,000 a month in rent from a tenant, a yearly 10% fee for our property manager. You could eliminate this if you plan to manage the property yourself. Let's assume we increase the rent on average 2% per year and a 2% tax increase per year for the property taxes. Monthly maintenance on the house, because there are lots of costs you incur as a landlord, and let's add in an inflationary increase to that maintenance cost because that's reality. The conclusion, we have paid off $27,000 in principal after 10 years. Assuming a 2% increase per year in home value, our equity in the home is now worth $115,000. Cash from rent is a little over $14,000 in that 10-year period. I put a line item here for major expenses outside of the regular maintenance costs. Again, feel free to eliminate this. I've talked to enough property investors to know this is a very real thing. New roof, HVAC, sewer lines, etc. A lot can happen in 10 years. I think $10,000 plus our maintenance fees feels about right. This leaves us with a total position value of $120,000 after 10 years. A much better return than the REIT. Keep in mind though, the return on the property comes much later. After 5 years, the REIT might actually outperform the real property. However, the longer you hold on to the property, its returns accelerate much faster as you gain more equity in the home and increase the rent year over year. There's a simple reason the real property outperforms the REIT over time, and that's the leverage. That 30-year mortgage really makes all the difference here. I wish I could get a 30-year mortgage for my REIT portfolio because I'd be crushing it. Of course, you do need to weigh the property returns against the time you are putting into it, and that time factor is the one that always gets me. I'd much rather spend my time making YouTube videos apparently than managing a property, and I'm okay with that. I don't have a burning passion to manage a property. I'd much rather put my money to work for me in REITs, and that's exactly what I do. If you do have that burning passion, then get on Zillow, contact your real estate agent using the number on the refrigerator magnet, and get yourself a property, why don't you? Okay, thanks for watching. Go find some value.